Hi, I'm John Mousseau. I'm the President, CEO, and Director of Fixed Income here at Cumberland Advisors. It is Thursday afternoon, December 31st. Happy New Year, everybody. We closed the bond markets for the year, very unchanged since basically Christmas Eve, with the 10-year bond at 0.92 and the 30-year bond at 165. Those are basically one tick lower than they were last week. Muni Bond yields running around 75 to 80% of those numbers. Clearly a dead week in Munis, really a dead week in the bond market too. More importantly is what are we looking forward to as we go to next week? Biggest thing, number one, numero uno, is the Senate elections on Tuesday in Georgia. We know that the Democrats win both Senate seats. They control the Senate because of the vice presidential vote. If they split or lose both, the Republicans maintain control of the Senate. Why that's important is the perception in the bond markets of possibly higher spending, faster spending, easier to get bills through with a Democratic Senate to go along with a Democratic House and a Democratic President. So we will be watching that. We will see how the bond market reacts next week and come back to tell you all that. We will look at initial jobless claims next week. They came in a little lower than expected. That's a good thing. And we hope that 2021 will be a much better year. We saw a great rebound in the markets, both municipal bonds, corporate bonds this year, from the very deep, troubled markets that we were in earlier in the middle of March. We have to thank the Federal Reserve and the Treasury for really coming to the rescue earlier this year. I don't think we can underestimate how much that helped, because knowing we had that backstop really helped these other markets other than treasuries to rebound and prosper as the year went on. With that, we wish you all a very healthy and happy New Year, and we'll see you next week.
Hi, Matt McAleer, Director of Equity Strategies. New Year's Eve, right near the close of trading for the year. If you had told me back in March that the NASDAQ 100, the NDX, would finish the year up 47%, and the S&P 500, at that time intraday down 32% year to date, would finish the year up 17 plus in total return, you could have won a lot of money off me in a heads-up bet there. I think anyone would have written down for a flat year at that point. Shows you what liquidity can do to markets. In terms of the Fed loosening, we saw an immediate bid in the bond market, which really carried over to the equity market. Remember, we talk equities on this side of the video an awful lot. John talks bonds. Without a bid in bonds, equities are always in trouble. So when the Fed started backing corporate and municipal debt back in March, it was very helpful. And it's really been off to the races since then. There's been 2 8–9% pullbacks mid-year. They shook some people out of the market. Headlines never ended. COVID, 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 politics. Those headlines shook people out of the markets. Keep in mind, most important thing to us and to yourselves as investors and traders is not the headlines. I tend to harp on this a bit, even internally. It's how the markets react to headlines. And what we've seen is a firm bid, partly due to that liquidity, partly due to the fact that markets price in negatives well before those negatives end. When we combine those two, we've seen nice lift. One thing we know about 21 is that there will be twists and turns that you and I do not have in our playbook today. There is every year. There'll be some things that hit the markets that we're not anticipating. Remember, politics, the election rather is over. COVID, for as far as the economy and the world is not over, for as far as the market is, that's been priced in months ago. Can there be a scenario where vaccines don't roll out in as timely a manner that's hoped? Sure. I don't know if that can knock the market down. It would probably be something we're not discussing. So just as a wrap up, I wanted to share a chart with you. Just gives you an idea in the three major asset classes what the annualized return has been the last 10 years plus an overall return. Look at the S&P. Look on the far right. Since 2010, up 318% over that span. Keep in mind the TR stands for total return. Sometimes we look at just price. Today we're looking at total return, which includes dividends and coupons, obviously, on the fixed income side. Not too bad in terms of the iShares US Core Bond ETF. Over 50% return. Keep in mind it's done that while the Fed, for a good portion of that, has been at close to zero interest rates. The commodities equal weighted index, the Thomson Reuters, is really the shocker, right? For the last 10, 11 years, you have a negative net return in commodities. Now keep in mind that's equal weighted. So there are different areas in precious metals or energy where you've been able to make money if you've traded around that. The point of this chart is to try to realize that from year to year, different asset classes will lead. And what we want to always do is be respectful of risk, respectful of reward. As much reward as we can get per dollar of invested capital with the least amount of risk is that magical compounding number. So in terms of 21, 22, 23, one thing we can probably guarantee is we don't know what this chart will look like. We don't know what asset classes will lead. We'll be flexible, try to continue measuring risk and reward, and putting capital to work where we feel that ratio delivers the best bang for the buck. Everyone have a great New Year's weekend, 3-day weekend. We'll get started on Monday. We'll be back at the end of next week to talk about week number 1 in 2021. Have a great weekend.